the 12th of September, 2025. Ibrahim Traoré stood before the people of Burkina Faso and declared, "My people do not need empty promises. They need fertile fields to feed their children, and schools to give wings to their dreams. I am not a hero. I am simply a son of this soil, striving to restore the dignity that our nation deserves." Under Traoré's leadership, Burkina Faso achieved what most other countries only talk about. The government officially took full control of 5 major gold mines without the involvement of any foreign investors. These were not abandoned sites waiting to be explored. These were active, producing mines. Some of them had been operated by Canadian companies for more than a decade. But now, every ounce of gold extracted from the ground of Burkina Faso is managed by a newly created state-owned company called SOPIB. And just like that, Canada's influence in Burkina Faso's gold sector was brought to an end overnight. Before we go further, give this video a thumbs up. It helps the message travel farther. The decision was not sudden. For months, there were signs that the Burkinabe government was no longer willing to let foreign firms dominate its most valuable resources. In August 2025, a mining code revision was passed. Then came the creation of a national mining company. But few expected the government to move this fast, or to go this far. Until recently, Canada had been one of the largest players in West African mining. Its influence was so strong that some of the region's largest mining projects had boards and executives based in Toronto. But the balance has now changed. Burkina Faso has rejected the old rules of extraction and replaced them with state-led strategies aimed at controlling value, production, and profit. Burkina Faso is Africa's 4th largest gold producer, producing more than 57 tons of gold in 2023. At current gold prices, that equals roughly $3.8 billion worth of precious metal coming out of the ground every single year. However, most of that wealth was always boarding flights to Toronto, Montreal, and other international financial centers. Meanwhile, Burkina Faso remained one of the world's poorest countries. The moment Ibrahim Traoré came to power, he began asking uncomfortable questions. How can a country sitting on billions of dollars worth of gold still struggle to fund basic infrastructure? Why are mining executives in Canada getting richer from our gold than the people who actually live above it? The answers he found led to the most dramatic resource takeover in modern African history. It did not happen through protests. There were no viral headlines, no breaking news tickers on international television. Yet, within a single year, Canadian mining firms lost their foothold in one of West Africa's richest gold zones. The process began with signals, quiet but unmistakable. In early 2024, Burkina Faso's transitional government started tightening its grip on the mining sector. New policies were rolled out, giving more decision-making power to local authorities. Bureaucratic hurdles increased for foreign firms. New taxes were proposed. Licenses were reviewed. Then came the game changer, the revision of the National Mining Code, in August 2025. That was the turning point. The revised code did not just update the rules, it rewrote them. A mandatory 10% stake for the state in all new mining operations was introduced. But the real surprise was that, under the new code, the government reserved the right to increase its share to as much as 70% in strategic cases. It was clear that the targets were the large-scale gold producers, most of which were foreign, especially Canadian. Within months, operations owned or run by companies like Semafo, Endeavour Mining, and others began facing resistance. Contracts were re-examined. Environmental audits were demanded. License renewals were delayed. Behind the scenes, there was pressure to hand over assets voluntarily. By the end of 2024, the government made it official. 5 major gold mining operations, all previously foreign-run, would now be operated by a new national company, SOPIB, short for Société de Patrimoine Minier du Burkina. Some Canadian firms did not fight back. They did not file international claims or go to arbitration. They simply walked away. Fortuna Silver Mines, a major player with projects across Latin America and West Africa, issued a statement in May 2025 saying it was shifting its investment focus to Guinea. It did not mention Burkina Faso by name, but it did not have to. It was obvious that the conditions in Burkina Faso were no longer suitable for Canadian mining firms. Why did they not push back? There are several reasons. Burkina Faso was not offering compensation or buyouts. It was a clean state takeover. Challenging that in international courts would be expensive and politically risky, especially since many of these firms also operated in other parts of Africa and did not want to risk losing more licenses elsewhere. But most importantly, Burkina Faso did not blink. The government did not meet the firms halfway. It did not offer middle ground solutions. Instead, it made it clear. Resources under Burkinabe soil would now benefit Burkinabe people. First, foreign participation would still be allowed, but only under new rules that gave the state full control. The Canadian government has also faced criticism, both at home and abroad, for the behavior of its mining companies in Africa. Allegations of environmental damage, labor violations, and unfair profit sharing have followed Canadian firms for years. If Canada had aggressively defended corporate interests in Burkina Faso, it would have reignited these debates and potentially damaged Canada's global image. So, Canada stayed quiet. The silence was not approval, but it was not resistance either. It was a signal that Canada understood the ground had shifted. Burkina Faso was no longer negotiating from a position of dependency. It was setting the terms, and Canada could not challenge that reality. What followed was like an intense shuffle. Canadian companies found themselves out of the game, with no seat left at Burkina Faso's mining table. That is how Canada left. No ceremony, no negotiation, no fight. Just the quiet sound of contracts expiring and offices closing. However, it is interesting to see how these companies are changing the story of their forced exits. They now talk about security concerns and regulatory uncertainty, as if they were the victims of some unfortunate misunderstanding. But the reality is much simpler. They are being fired from jobs they thought were permanent. Burkina Faso planned and executed its mining takeover. It was strategic economic warfare, not a random act of resource nationalism. It was part of a broader agenda aimed at true freedom from neo-colonial powers. And the results came quickly. Share prices of foreign mining companies started to fall the moment investors realized what was happening. Billions in market value evaporated as the reality sank in. The era of easy African mining was over. Government figures show that state-controlled initiatives collected over 8 tons of gold in 2024 and more than 11 tons in the first quarter of 2025 alone, primarily from formalized small-scale operations. These figures represent gold that is staying in Burkina Faso instead of enriching foreign shareholders. Think about what 11 tons of gold in just 3 months means. At current prices, that is roughly $780 million worth of gold collected by state entities in the first quarter of 2025 alone. Money that is now funding schools, hospitals, infrastructure, and economic development. Instead of dividend payments to pension funds in Toronto, when foreign mining firms left, they did not leave behind empty pits or ghost towns. They left behind fully operational mines, some producing hundreds of thousands of ounces of gold each year. Rather than auction these mines off to the next foreign investor, the Burkinabe government had other plans. They created SOPIB. SOPIB was not an afterthought. It was not a shell company built just to manage paperwork. It was designed from day one as a functional replacement for the large multinational firms that once controlled the country's gold sector. The full name, Société de Patrimoine Minier du Burkina, means Burkina Mining Heritage Corporation, but there is nothing symbolic about what it does. It holds mining licenses and operates extraction sites. It also manages logistics, staffing, transport, and export. In short, SOPIB is a mining company. The company was founded with 2 goals. First, to keep production stable during the transition, so there would be no shutdowns or missed targets. Gold had to keep flowing not for foreign shareholders but for the state. Second, to create an institutional backbone for a long-term state-led mining industry. To do that, SOPIB absorbed local technical staff who had previously worked under Canadian firms, geologists, engineers, plant operators, and finance teams. Many of these professionals were Burkina Faso nationals, already doing the groundwork while decisions were made abroad. SOPIB brought decision-making and operations under one roof. And for the first time, that roof was in Ouagadougou, not Toronto. What makes SOPIB different from past national mining experiments in Africa is that it did not start from scratch. It took over fully built mines, with trained personnel and operational systems already in place. But running a mining empire is expensive. SOPIB did not pretend otherwise. Instead of relying only on state funds, the company built partnerships with private logistics firms and regional contractors. It issued contracts to Burkina Faso companies for haulage, maintenance, and security. In doing so, Burkina Faso pulled dozens of previously sidelined local businesses into the mining economy. The new state-owned company also renegotiated export terms. Under previous regimes, the majority of gold exports were funneled through foreign refineries. SOPAM began direct talks with other African nations, particularly Mali and Niger, to explore the creation of a regional refining hub. The objective was clear: add value at home, not abroad. SOPAM may still be young, and the risks remain real, but what makes it remarkable is its function, not its age. In less than a year, it has replaced a network of multi-billion-dollar corporations, maintained production, and rewired the entire gold value chain within Burkina Faso's borders. This is not merely an alternative to Canadian firms. It is a rejection of dependency built brick by brick, site by site, and staffed by the very professionals who once worked under foreign logos. Burkina Faso now has a mining company it owns, and, more importantly, one it controls. And Burkina Faso is not acting alone. It is part of a coordinated regional shift that is rewriting the playbook of African resource control. Alongside Mali and Niger, 3 former colonies have chosen to stop being the world's raw material suppliers and instead become their own resource powers. This coordination is no accident. Mali holds some of the richest gold deposits on Earth. Niger controls uranium reserves that fuel nuclear reactors across Europe, and Burkina Faso sits on vast mineral wealth. On their own, each of these countries could be pressured, isolated, or economically strangled by international mining interests. But together, they form a bloc that is far harder to bend. Together, they now form a formidable bloc that controls resources essential to global supply chains. This newfound unity is not merely political, it is operational. By coordinating their strategies, these nations are not only resisting external pressure, but also proving that they can manage the complex machinery of resource extraction on their own terms. Burkina Faso's takeover of its mining sector has shaken entrenched ownership structures and exposed a long-standing falsehood: the idea that technical expertise must always come from abroad. For decades, one of the most persistent lies in international mining has been that African countries lack the skills to run modern, large-scale operations. That myth has served as the justification for foreign dominance and the deliberate withholding of technology transfer. But Burkina Faso has now demolished that narrative. The very same engineers who once extracted gold for Canadian firms are today extracting it for their own state enterprises. The same geologists who map deposits for foreign shareholders are now mapping them for national development. The same metallurgists who optimize production for multinational corporations are now optimizing it for their own people. The expertise was always there, only the ownership has changed. What had been missing was control. One of the most remarkable aspects of Burkina Faso's mining strategy is the way it has integrated small-scale traditional mining operations rather than marginalizing them. International mining companies have long regarded small-scale miners as nuisances to be cleared away, obstacles to efficient extraction. The government of Burkina Faso, however, treats them as partners supporting, regulating, and incorporating them into the national mining strategy. This approach acknowledges that mining expertise exists at every level of society, not just in boardrooms in Toronto. It is about building an inclusive mining economy rather than an extractive one. But nationalizing existing mines is only the beginning of Burkina Faso's resource revolution. The true economic transformation lies in developing the capacity to add value locally, instead of exporting raw materials overseas for processing. To that end, the country has approved the construction of its first gold refinery. an historic step that signals the transition from exporting raw ore to producing refined products domestically. This is where the economic impact becomes truly transformative. Refined gold commands significantly higher prices than raw ore. Refining creates skilled jobs, while also driving the growth of supporting industries, equipment manufacturing, chemical processing, quality control, and logistics networks. By moving up the value chain, Burkina Faso is no longer positioning itself as just a supplier of raw materials, it is establishing itself as an emerging mineral processing economy. That is the difference between being a colonial supplier and becoming an industrial power. What is now unfolding in Burkina Faso represents a fundamentally new economic model for African resource extraction. Instead of foreign corporations siphoning away the majority of value from African resources, state-owned enterprises are retaining profits domestically to drive national development. Revenue that once filled pension funds in Toronto and investment portfolios in London is now financing infrastructure, schools, hospitals, and industrial projects in Burkina Faso. The very same gold deposits that generated steady returns for distant shareholders are today generating development capital for the people who actually live above them. For international mining giants, what is happening across West Africa is more than symbolic. It is an existential challenge to business models that have dominated for more than a century. Supply chains once controlled from boardrooms in Toronto, London, and Sydney are increasingly shaped by decisions made in Ouagadougou, Bamako, and Niamey. Now, when Chinese manufacturers seek gold for electronics or European utilities demand uranium for nuclear power, they must negotiate directly with African governments rather than cutting deals exclusively with Western mining executives. The revenue flows have shifted. What once left the continent is now being reinvested at home. But this transformation goes deeper than simply keeping mining profits at home. State-controlled mining operations in Burkina Faso are laying the foundation for local financial institutions, training homegrown experts, and creating domestic capital markets capable of supporting large-scale mining development. Instead of depending on international banks for project financing, they are building financial capacity at home. Instead of relying exclusively on foreign currency for equipment purchases, they are forging regional trade relationships that strengthen African economic ties. This kind of financial independence is just as crucial as operational independence. It allows African nations to make mining decisions based on their own economic priorities, rather than the dictates of international financial institutions. What makes Burkina Faso's mining revolution remarkable is not just its ambition but its effectiveness. Despite the usual warnings of inefficiency and mismanagement that accompany nationalization, state-run mines are not collapsing. In fact, they are maintaining and in some cases even increasing production. What we are witnessing is a very different nationalization story. The birth of a new African model for resource control that has the potential to permanently reshape global mining dynamics. Until recently, most nations approached multinational mining firms using the same formula: offer generous tax incentives, guarantee stability clauses, issue exploration licenses, and compete against one another for foreign capital. The prevailing wisdom was that resources in the ground were worthless without international financing and technology to bring them out. For years, Burkina Faso played by those rules. But today, those rules are being rewritten. The country has introduced an entirely new way of engaging with international capital, one that provides something rare: to leverage. The success of state-controlled mining demonstrates that African nations do, in fact, have the technical expertise to manage their own resources, and that success is spreading, inspiring others to follow. The integration of small-scale mining demonstrates that development strategies can be inclusive rather than extractive. The construction of processing facilities proves that African nations can move up the value chain. Most importantly, mining revenues are staying in Africa, financing African priorities rather than flowing to shareholders in Toronto, London, and Sydney. Across the continent, other governments are watching closely, learning, and adapting these strategies to their own circumstances. The legal frameworks that enabled Burkina Faso's nationalizations can be replicated elsewhere. The institutional models that sustain state-controlled mining can be tailored to fit different national contexts. Not every country will choose the same path. Some may still prefer joint ventures, while others may focus on higher royalties rather than direct ownership. But the old playbook, the one that insisted governments must always accommodate foreign capital to remain competitive, is being steadily abandoned. Multinational mining corporations that have dominated African resource extraction for more than a century will either adapt to this new reality or find themselves shut out of some of the richest mineral deposits on Earth. Canadian firms in particular, which built their growth strategies on African concessions, are beginning to realize that those concessions were never as secure as they believed. The era of guaranteed access to African resources is drawing to a close. What replaces it will depend on whether international mining companies can forge genuinely equitable partnerships with African governments, partnerships built on respect, transparency, and shared benefit rather than exploitation. Companies that offer genuine technology transfer, create substantial local benefits, and build true partnerships may still find opportunities in Africa. But those clinging to the old colonial model of maximum extraction with minimal benefit for locals will be forced to join the exodus from a continent that has finally chosen to control its own destiny. African mining will never be the same again. So what do you think? Should more nations take direct control of their natural resources? Was Canada right to walk away without a legal fight? And can state-owned companies truly outperform multinational giants in the long run? Share your thoughts in the comments below. If you found this analysis valuable, give the video a like, subscribe to the channel, and hit the notification bell so you never miss the next story. We have more powerful insights coming soon, stories that will change how you see Africa and how you see the world.